Welcome back to the deep dive. If you've ever felt that trying to figure out the market from the news is like, I don't know, guessing a book's ending just from chapter titles, well, today's topic might be for you. We're kind of hitting reset on how we look at markets. Forget the economic forecasts for a minute, forget company balance sheets. We're setting that aside today.
Yeah, we're diving deep into technical analysis. It's this whole other approach, really. It suggests the market actually tells its own story, truthfully, constantly, but only if you know the language. You know, the language of price, volume, momentum.
Right. And our main source for this is a classic, often called the Bible of this field, Technical Analysis of the Financial Markets by John J. Murphy. Our mission really is to pull out those core ideas, the ones that help you move from just watching the market to actually reading its story with some discipline.
And maybe a helpful way for you, the listener, to think about it is this. Technical analysis is kind of like the diagnostics lab for the market. It's not about predicting one single event perfectly. It's more about diagnosing the market's current health, seeing where it's likely heading. Think of a doctor checking pulse, blood pressure, temperature, right, to get the full picture. We use charts and specific indicators, mathematical ones, to gauge what's going on inside the market.
Okay, let's dig into that core philosophy then, because it really does challenge how a lot of people invest, doesn't it? Murphy's whole thing is based on this, well, kind of radical idea that you predict future prices just by looking at past data.
Exactly. Past market data. He basically works on the assumption that why a price changed is less important than the fact that it did change.
That's a key difference.
It is. And technical analysis really stands on three main pillars, philosophically speaking. The first one, the one that gives the whole field its grounding, is that market action discounts everything.
Okay, that sounds big. Discounts everything. For someone new to this, what does that actually mean in practice?
It means that pretty much any piece of information you can think of, geopolitical news, an interest rate surprise, some viral tweet, even a great earnings report it's already known, or it's anticipated, or it's being processed by millions of traders out there. And so its impact, it's already reflected in the current price.
Ah, so the price itself is the consensus.
Precisely. If a stock's at $100, that price represents the collective wisdom, or maybe folly, about all the known factors. So, if the price already reflects the news, why study the news? Studying the price movement itself is more direct. It shows you the shifts in supply and demand.
Right. It's the ultimate crowd psychology readout, which I guess leads straight into the second pillar, the one that's crucial for any trading strategy. Prices move in trends.
Absolutely essential. A trend is just the sustained direction of the market, right? Up, down, or sideways. And the reason we care so much is momentum. Once a major trend gets going, up or down, usually the easiest path to price is just to keep going. It takes a lot of force, a big shift in thinking, to actually turn a major trend around.
Yeah.
So the technical analyst's first job, the most critical one, is just identifying the trend that's already in place and knowing when it might be ending.
And the third piece ties the past and present together. History repeats itself. Why would patterns from, say, the 1950s still matter today with algorithms and high-speed trading?
Because the tech changes, but the people don't. Fundamentally, anyway. We're studying human psychology mapped onto price charts. Those core emotions driving markets, fear, greed, hope, panic, they're timeless. They haven't changed. And because that psychology is pretty consistent, the way these emotions show up on a chart, specific shapes, reversals, pauses, they tend to follow predictable patterns. It gives us a reliable toolkit, regardless of what's being traded.
Okay, philosophy down. Let's talk practical tools. The language, as you said, this is where we look at the actual visual evidence on the screen.
Right, the charts. Murphy covers the main types. You've got the simple line chart, which just connects closing prices. Good for a quick overview. But most serious work uses more detailed charts. The bar chart gives you 4 key prices for each period: the open, the high, the low, the close, the OHLC.
But the one a lot of people favor visually, maybe for getting a quick feel for sentiment, is the candlestick chart. Yeah.
Definitely. Candlesticks are really intuitive. The color and the size of the main part, the body, instantly tell you if the price closed higher or lower than it opened, and kind of how strong that move was. Green for up, red for down, usually.
So once you've got your chart up, the first task is identifying that main trend we talked about.
Correct. An uptrend is pretty clear visually. You look for a series of higher highs, each peak is higher than the last one, and higher lows, each valley is higher than the last, like climbing stairs.
And a downtrend is just the opposite, right? Lower highs and lower lows, like going downstairs.
Exactly. And sometimes the market just can't make up its mind. It goes into a sideways trend or a range.
Yeah.
The price just bounces back and forth between a ceiling, resistance, and a floor support.
Okay, and this is where those patterns you mentioned come in, the shapes that form on the chart.
Precisely. These specific formations are like signals. To someone who knows what to look for, they suggest that the market psychology is shifting. Maybe a reversal is coming, or maybe the current trend is about to continue strongly.
Give us a classic example, maybe one of the most famous reversal patterns, the head and shoulders.
Ah, yes, the head and shoulders. Classic sign that an uptrend might be running out of steam. Visually, it looks just like it sounds. You get a price peak, that's the left shoulder, then an even higher peak, the head, and then a third peak, but this one's lower than the head, the right shoulder. The key is the neckline, a line drawn connecting the lows between those peaks. If the price breaks decisively below that neckline, it's a strong signal. It suggests the buyers have lost control and a downtrend is likely starting.
Okay, I can picture that. And there are others too, like double tops and bottoms. They look like an M or a W.
Right. They show the market tried to break through a key price level twice, maybe a high for a double top or a low for a double bottom, and failed both times. Suggests a reversal is likely.
And triangles.
Triangles show the price action getting squeezed into a tighter and tighter range, like coiling a spring. It signals that energy is building up, usually for a sharp breakout, either up or down. You often look for other clues to guess the direction.
So charts and patterns give us the map showing potential routes. What about the GPS, the things that give us more mathematical confirmation?
That's where the technical indicators come in. These are calculations based on price, sometimes volume too. Their main job is confirmation. They help quantify things like momentum and volatility to either support or maybe contradict what the chart pattern seems to be telling you.
Okay, let's touch on the big ones Murphy covers. Starting with moving averages, MAs. What do?
Moving averages basically smooth out the day-to-day price noise so you can see the underlying trend more clearly. Imagine drawing a smooth line through the jagged price action. But there's an important detail. The difference between a simple moving average, an SMA, and an exponential moving average, an EMA.
What's the practical difference for someone trying to use them?
Well, the SMA gives equal importance to all the prices in its calculation period. So a 20-day SMA treats day 1 and day 20 the same. This makes it smoother, but also slower to react. It lags a bit. The EMA, though, gives more weight to the most recent prices, so it reacts faster to changes in direction or momentum. Many traders prefer EMAs in faster-moving markets for that reason.
Got it. Faster reaction with the EMA. Okay, next up, maybe the most famous momentum gauge, the Relative Strength Index, RSI. This helps avoid chasing moves that are already exhausted, right?
Exactly. The RSI is what we call an oscillator. It moves back and forth, usually between 0 and 100. It measures how strong the recent gains are compared to the recent losses. The standard interpretation is pretty straightforward. If the RSI goes above 70, the asset is generally considered overbought. Buying pressure might be drying up, a pullback could be coming. If it drops below 30, it's considered oversold. Selling might be overdone, a bounce could be near. The key insight isn't that it must reverse at 70 or 30, but it warns you the market is stretched in one direction. The risk of reversal is higher.
Okay, useful warning signal. And the third big one, moving average convergence divergence, MACD. Sounds complicated, but it's popular.
It is a bit more complex, but incredibly versatile. The Mankey basically measures the relationship between two different EMAs, typically a 12-day and 26-day EMA. You get a MACD line, another line called the signal line, which is an EMA of the MACD line itself, and usually a histogram showing the difference between the two. But where the Mankey really shines is in spotting divergence. This is crucial. Let's say the stock price is hitting new highs, right, making higher peaks. But at the same time, you look at the Mankey indicator, and it's making lower highs. That mismatch, that divergence, is a huge red flag. It suggests the upward momentum is fading, even though the price is still going up. Often, it's one of the earliest warnings that a trend might be about to change.
That divergence concept sounds really important, which leads us perfectly to what Murphy calls the rule of confirmation. Why is it so dangerous, especially for newer traders, to just act on one signal?
Because markets are noisy. They throw out false signals all the time, head fakes, traders call them. Imagine the RSI drops below 30. Looks oversold, righty. If you jump in and buy right away based only on that, you might be catching a falling knife, as they say. The price could just keep tanking.
Ouch.
Exactly. So discipline demands confirmation. You need multiple signals pointing the same way. Maybe you wait for the RSI to not just dip below 30, but to climb back above it. And you look for the Mankey D to show a bullish crossover. And maybe you see a reversal pattern like a double bottom forming on the price chart itself. When you get several independent signals agreeing, your odds of being right go up dramatically.
Okay, so we have the philosophy, the charts, the indicators, but none of it works without the right mindset, does it? Murphy spends a lot of time on the psychology of it all.
Oh, absolutely, because this is where most people stumble, even if they understand the technicals. The biggest fight isn't with the market, it's with yourself. It's managing fear and greed. You can have the perfect technical setup on your chart, but if you panic and sell the minute the price dips a little, or if greed keeps you holding on way past your profit target hoping for more, the setup doesn't matter. You need discipline. And a huge part of that is risk management.
Which means having a game plan before you even click the buy button. And key to that plan are things like stop-loss orders and having clear profit targets.
The stop loss is non-negotiable for serious traders. It's your escape hatch. It's deciding before you're in the heat of the moment at what price point you'll admit you were wrong about the trade and cut your losses. By setting the order beforehand, often automatically, you take the emotion out of that decision when the price moves against you. You define how much you're willing to risk on this specific trade. That prevents one bad call from devastating your account.
And the profit target does the opposite for greed.
Exactly. It prevents you from holding on too long, watching a good profit evaporate because you got greedy. Hit your target, take the win, look for the next opportunity. Discipline works both ways.
Okay, and one last layer Murphy adds, which elevates the whole discussion, is intermarket analysis. The idea that you can't just look at one market in isolation.
Yeah, this is the big picture view. Financial markets are all connected, like a web. What happens in the bond market, for instance, definitely affects the stock market. If bond yields are shooting up, that often means money is getting nervous and moving out of riskier things like stocks. It makes borrowing more expensive too. Similarly, look at commodities. Big moves in oil or gold prices, they ripple through currencies, inflation expectations, and ultimately stock market sentiment. Understanding these connections gives you another layer of confirmation, or maybe a reason to be cautious about your primary analysis on, say, a single stock chart. It gives you a sense of the global flow of money and risk appetite.
So wrapping this up, what's the big takeaway for you, the listener, from this deep dive into Murphy's work? It seems like he built this really accessible, but still very thorough guide. It's a framework based on discipline, looking at probabilities, understanding that historical psychology repeats itself. It's really trying to move away from just guessing.
It really is a timeless toolkit. Seriously, whether you're applying these ideas to a big, stable blue chip stock or some volatile futures contract or even, a new crypto asset,
Yeah.
the human behaviors that create trends and patterns, they're pretty constant. Success really comes down to mastering these tools, yes, but maybe even more importantly, mastering your own reactions, your own psychology.
Yeah, ultimately, the market itself doesn't feel anything. It just reflects the sum total of all the feelings, the fear and greed of everyone participating in it.
Which brings up a really interesting final thought for you to chew on. If technical analysis argues that the market price already discounts all the known information, all the news, then how much of your own anticipation, your own fear about a crash, or your own greed hoping for a moonshot, how much of that is already being reflected back at you in the price action you're analyzing? That's the real challenge, isn't it?